You are most welcome to this interesting, exciting seminar today on commodity currencies. And it's interesting from at least three main aspects. One, is very much relevant to the current economic climate of global liquidity crunch, where economies are trying to recover from the post-COVID situation and lockdown, and facing a lot of challenges with not only liquidity but also with exchange rates, with inflation, and macroeconomic instability rising from the COVID shock and the subsequent shocks with the war and the global economic climate. So it's very timely in that case. But there is also another aspect, or that there is a need for rigorous scientific research to provide some insights into commodity currencies. And this paper does just that. Provides a strong econometric evidence that is necessary now in view of knowledge-based economies to address some of the challenges that we face. And the third aspect is that it's appropriate, also timely, in terms of for us to think about what the evidence means. What do these findings in this paper mean? Does it mean that actually, if there is, commodity currencies show clear stability between the prices of commodities and the value of currencies or exchange rates, to the extent that maybe commodities can be used as an anchor for the strength of currencies? And of course, if we cast our insight back into the gold standard and the role of gold in guaranteeing the value of currencies, the guarantees have continued to shift from period to period. So in the last 100 years, we've seen quite a lot of changes in the way the global currencies are managed. Will the evidence on commodity currencies provide extra insight into how we can manage currencies and exchange rates? Okay, so there are many interesting aspects of this paper, both in terms of the background, in terms of the empirical work that is done and presented here, this discussion, and of course, that it will provide us a lot of thought about how we input the evidence from this work into economic policy. And I'm delighted to see here quite a number of the distinguished scholars from all over the world, but also to see a number of practitioners, policymakers who are at the forefront of addressing these challenges or looking for answers in view of the current global challenges. We pay gratitude to the presenters, and we are grateful here that we have a very top-notch researchers who have actually been looking at this issue for quite some time. And let me then have the pleasure of introducing the two researchers who have worked tirelessly behind the insights in this paper and are presenting the work today. So the presentation will be from Dr. Sophie van Huellen, who is a lecturer in development economics with the Global Development Institute at the University of Manchester. And I should add that Sophie was here at SOAS, University of London, only a couple of years back, and an active participant in the Center for Global Finance seminars. She's very prolific. Her research focuses on primary commodity markets and the issues of commodity dependence, finalization, and macro financial linkages. So really, this is work that she has spent quite many years looking into. And she's a graduate of the University of in Germany with a BA in Economics, Politics, and Philosophy. and then further trained to obtain an MSc and a PhD at this very own SOAS, University of London. So she's home, away from home, in this seminar presentation today. And Sophie is partnered in this presentation or on this paper with the Dr. Rafael Palazzi, who is a postdoctoral researcher at the Sao Paulo School of Business Administration in Getulio Vargas Foundation, a very renowned institution for work in economics. And Rafael has research interest in time series analysis, forecasting, commodity markets, biofuel markets, absolutely relevant in thinking about these issues and even paving the way and how we should continue the conversation around here. And he obtained a PhD in finance from the Pontifical Catholic University of Rio de Janeiro, and also holds a master's and BA degrees in economics from the same institution. So it's also great pleasure to see that this is like a global space where the seminars are presented by researchers, both from Manchester in the UK and also from Sao Paulo School of Business Administration in Brazil, and the participants from all over the world. So please join me in welcoming Sophie and Rafael for the presentation. But quickly, before I invite them to the presentation, let me say that, let me call upon the audience to post your comments, observations, questions in the chat room. But of course, you'll have a chance at the end of the presentation to ask the question. There will be a Q&A. So with great pleasure, let me welcome Sophie. Put our hands together to welcome Sophie and Rafael. You are most welcome. Please go ahead.
Thank you.
Thank you, Victor. Thank you so much for this kind introduction. And yeah, home away from home. That hits the nail on the head. Let me share the presentation. And yeah, I'm very grateful for being back, and thanks so much for inviting us. I hope you can see the presentation. If not, let me know. As Victor already said, excellent, thank you. We represent on commodity currencies, which I know is a timely topic, and as Victor exactly outlined, it is a timely topic. It's a very old topic as well. So the question of how commodity-dependent economies manage their macroeconomy, including their exchange rate, has been on the research agenda for decades, rightly so, and it still is. Our results are a bit more mature than the last time I presented this paper, not in this seminar, in a different context, but I saw that some of the people in the audience will have seen an earlier version. The results are still preliminary, but stronger than before. So yeah, there's something new for those who have seen it before. We will be trying to unpick, not only describe what makes a commodity currency, but also unpick the relationship between commodity prices and exchange rates. So that's the overall goal of the paper, not only establishing whether there's a relationship or not, but also looking at what are the, if you want, transmission mechanisms through which this relationship is established. Yeah, I will start the presentation and then Rafael will take over halfway through. So I will outline a very brief motivation as well as theoretical model that we used in order to motivate then our empirical analysis. So Rafael will take over the method and data section and then the empirical evidence, and we will then have a brief discussion together at the end and then invite you for comments and questions. So please keep them to the end to not interrupt the flow and also give equal chance to everyone to ask questions. The motivation of commodity currencies has been an old one. So this is a simple plot that plots the four countries, the currencies, the exchange rates of the four countries that we are looking at in our study in particular, and an index for commodity prices. And we see that there seems to be some correlation. It's not necessarily consistent. There are differences across countries, but for some countries, it seems to be relatively strong, not necessarily over the entirety of the period. But from just looking at it, there seems to be a relationship. Of course, that's not enough to establish whether there's a covariance between the exchange rate and commodity prices, but just looking at the picture, it seems to be at least a question that is worth posing and investigating from what we see here. We will present in particular the results on Brazil, just because we started with Brazil. Given Rafael's expertise on the Brazilian economy, it seems fitting to look at the Brazilian case study first and also its exchange rate regime before we start with the other countries, which we have done but not quite completed. Brazil here is the yellow curve, and you can see that actually it varies with the overall commodity price index quite strongly until kind of 2015. And then maybe the relationship weakens a bit. We will learn later on that this is also a period where Brazil intervened quite heavily in its exchange rate. And then we see again when the COVID crisis hit that actually that relationship seems to break down, and there are various reasons for that. And actually empirically that gives us a few challenges as well. So there might be a story or an argument for subsampling in order to evaluate these relationships in a time series context. Oh, sorry. What do we mean by commodity currency? So the term was coined in the early 2000s in order to describe a co-movement between the exchange rates of commodity export-dependent economies mainly and primary commodity prices. And there are broadly two types of literatures that have looked into this commodity currency relationship. The first type are also in two subcategories, which trying to establish that empirically. So the early 2000s, where this co-movement was really looked at from an empirical perspective with a little bit of theoretical motivation, but that wasn't the main focus of the analysis. And then later on, so the slightly more recent literature, Chen et al. 2010, and then Ferraro et al. 2015, looked into the question, what is the lead-lag relationship? So is it actually that commodity prices are leading the exchange rate, or the exchange rate of commodity-dependent countries, and countries especially that have a large market power, market share in the commodities they are exporting, are then actually leading the commodity prices? Now, the other set of literature has looked at this from a slightly more theoretical perspective, and this is what we draw from when we build our theoretical model as well. So there's a very old literature from the 80s and 90s, which is basically the Dutch disease models, right? Gordon's Dutch disease model and the focus on terms of trade. Now, these theoretical models, although they're quite old, they then have motivated some of the analysis in commodity currencies from a theoretical point of view. So terms of trade here being understood as the main transmission channels through which commodity prices impact the exchange rate. Then we have a more recent literature which has emerged out of the great financial crisis in 2008, 2009, and then also later on over the different more recent commodity boom cycles. A lot of this comes out from the Bank of International Settlement researchers, which looks more on the link between commodity prices and balance sheets and risk premia. And then through that, although these papers not necessarily directly look at this, but also possible transmission channels through to the exchange rate via these, let's say, more financial channels rather than the trade channel, which is the terms of trade discussion. So we will use this literature in order to build our model, and we identify three possible channels through which we hypothetically think that the commodity price shock could influence the exchange rate. So the first one is the terms of trade channel. That's based on the 1980s, the old literature, Dutch disease kind of models. Then we have the risk premium channel, and then we also have a liquidity premium channel. So some of the discussion of the liquidity premium come also from the post-Keynesian literature on exchange rates and currency hierarchies, which is something that is extremely important if you want to understand the behavior of exchange rates in emerging markets or developing country context. So that's what motivates the last channel. The terms of trade channel is the first one I want to build. I will go through this relatively quickly also because these models are quite well known and they're a bit dry. So for any one of you who has done the old school macroeconomics courses, will look at this, and I think this is very familiar. There are a few tweaks we make, and I will mention them. So we assume a two-country, two-goods model, or three goods if you want. We have commodities, traded goods, and we have non-traded goods, and we have intermediate goods. So 4 goods overall, of which in the end only the traded is traded and the intermediate is traded. The non-traded is of course not traded, and the commodities is traded by the producing country, which produces primary commodities. We then divide between a home economy, foreign economy. Home economy produces primary commodities, non-traded goods, and imports the traded goods, which are manufacturing goods. And then the foreign economy produces non-traded, intermediate, and traded goods. It imports the primary commodity. It then combines them with the intermediary goods and produces the traded goods, which are then being exported to our home economy. So a very standard model. This is just to introduce the different notations. So Y is our product quantity, C is the consumption quantity, P is price level. If I use an asterisk, it means that it's denominated in a foreign currency rather than the domestic currency. A is our labor productivity, S is our nominal exchange rate, and then we have disposable income, which is simply the sum of the price times the quantity being produced of all the different products that are being produced in the economy. Now, the simple assumption or simplifying assumption that is always being made is that within the economy, at least in the long run, labor is mobile, so that the wages are equalizing out in the long run. And it's also assumed that the traded good only requires the input of primary commodities and the intermediary good. So that allows us then to express the price of the non-traded good in terms of a ratio of the labor productivity and the price of the commodity good or the intermediary good here. And that really is then needed in order to derive some form of the overall price level of an economy, right? So if we then say the overall price level of an economy is defined by the proportion of the different commodities that are being consumed, as well as, so what is the ratio of the consumption at the bottom here. So we have this little gamma that gives us what is the proportion of non-traded goods that are being consumed and the proportion of traded goods that are being consumed. And we're weighting this by the different price levels in the foreign and in the domestic economy. That gives us the overarch or over the CPI basically of each of the economies, so the price level. And that allows us to define the purchasing power parity, which we assume holds in the long run. So at least there is some sort of adjustment towards the long run. So this is assumed for now. This can be eased later on. Substituting all of this together then and taking the logarithm then means that in the end we do have a definition of our nominal exchange rate, which is defined by 2 different components. The first one is basically a Palazzi-Samuelson effect, the differential between the productivity of different sectors, as well as what is the share of the consumption goods that are being imported. And then the right-hand side, which is the important part, that's basically our terms of trade, the difference between the price level in these 2 economies. Yeah. Okay, moving on to the slightly more interesting channel, because it's some motorcycling noise in the background here. The risk premium channel. So the risk premium channel is a new addition to that very kind of traditional terms of trade model. In itself, of course, the uncovered interest parity is not a new equation. It's very well known. So what we have here is a very standard uncovered interest rate parity with the assumption that the assets, foreign and domestic assets, are not perfect substitutes. So that means that we have the interest rate differential between the domestic economy and the foreign economy on the left-hand side, which is equal to the appreciation expectation of the exchange rate plus a risk premium, which is the rho, and then fee for our liquidity premium. So these 2 premiums, which symbolize or quantify the unequal substitutability between different assets. We also use later on D for debt level and R for foreign reserves. I will motivate this in a second. Now, we use this uncovered interest rate parity assumption in order to then, in order to bring the model together. We also have to make assumption about how these expectations on appreciation pressure form. Now, we assume that exchange rates are a tradable asset. As a tradable asset, they are subject to traders' expectations. And we are assuming a mixture of two different trader types. So one trader type is basically forms on the expectation based on regressive expectation, which means that there is some assumption of some adjustment towards the equilibrium level of the exchange rate, and the equilibrium level here is defined via, as common, the purchasing power parity assumption. We also assume that there are some extrapolative traders, so extrapolative expectations, which means that trends are being expected to persist. So these are, if you want, some uninformed traders, and the top are some informed traders, and these together form the dynamics of the nominal exchange rate and to what extent and how fast it does adjust to its equilibrium level, here defined as purchasing power parity in terms of trade forms. The only bit that we haven't quite defined yet, and this is something that doesn't give us a headache, but will be part of our broader discussion, is how do we understand the risk premium and how do we understand the liquidity premium? So as a first step, we can go with the risk premium as the debt sustainability of a country, which is a common measure being used in order to assess a country's credibility and risk. And we can understand the liquidity premiums in terms of the convertibility of a currency, which then means that the convertibility is then related to the amount of foreign reserves that a country has. Which means that these two premiums are tied to, in one way or the other, to the amount of foreign exchange, and the amount of foreign exchange is tied to primary commodity prices through our current account, right? So the current account and the amount of commodities that are being exported then defines the changes in our foreign exchange if we don't assume any type of intervention. However, this assumption might actually not be justified completely, and the reasons are twofold. So we do see that a lot of emerging markets have used reserve currencies as a strategic or have hoarded these reserves for precautionary and strategic means. This hoarding has been done in a neutral way, so in a way that it shouldn't impact too much the exchange rate. However, it will break the relationship between the current account and the change in the accumulation of reserves. So if that's the case, as a policy that is maintained in a lot of emerging markets, including the 4 emerging markets that we have in our data set here, this relationship will not necessarily hold. The other thing is, if the domestic currency is traded on derivative markets, it's not the amount the central bank holds in terms of foreign reserves that determines the convertibility of the domestic currency into foreign currency, but rather the liquidity and the depths of the forex derivative market than the foreign exchange available to the central bank. Against this background, we do suggest 2 alternative measures, and that now relates back to the literature I cited at the very beginning when it comes to the risk premium in the terms of and its link to commodity prices. Now, the risk premium could be defined, and we follow a paper here, as the difference between government bonds that are denominated in the domestic currency and denominated in US dollars. If we have that, then we can also define the liquidity premium if we approximate the expected appreciation by the difference between the spot and the forward or futures price of the currency, and then just simply solve equation number 8, which was our uncovered interest parity with the 2 premiums attached to them. The problem here is that this requires that you have an economy which has had for a very long time, given that we're dealing with time series, a forward or futures market for the foreign exchange, and also has or issued bonds that are denominated in foreign currency, as well as domestic currency for quite some time. And according to our research so far, only Brazil fits this bill, so we will do this for Brazil in the future. Doing that at the moment, but we're having trouble to find appropriate data that approximates these relationships for other our other economies that is of sufficient length for now. I'm almost done with the dry part, so please bear with me. Now it's time to basically bring everything together. So if we combine our terms of trade equation with the equation we had from or derived from the uncovered interest rate parity and add the assumption about the adjustments or trader behavior to it, what we get here is our equation number 14. It's just simple and tedious algebra. Now, the implication of this is twofold. One is that extrapolative expectations slow the adjustment process, and also there's only adjustment if alpha is smaller than theta, which means that basically fundamental trader outweighs the extrapolative trader, which is in the long run probably a reasonable assumption. So then we have adjustment towards the long run, which is our terms of trade channel, and that adjustment is governed by these trader interactions, but of course also via policy interventions. And we also have some, so what this model is or then becomes is some sort of error correction model, basically, where we have some long run adjustment. Now, the dynamics of our model are relatively well, and that's something that a lot of exchange rate models have in common. It's well identified in the short run. It's not very well identified in the long run because, of course, there are various factors that define the long run impact and adjustments within the economy. Now we see at least in the short run, clearly defined our three different channels in this equation number 14, the terms of trade channel, the risk premium, and the liquidity premium channel. Now in the short run, we have this very clear kind of definition of how the nominal exchange rate should react to, in this case, just to give an example, to a commodity price boom, which is through all of these three channels adds an appreciation pressure, right? So we have the commodity prices going up, we see appreciation pressure. The risk premium is going down as a result of the increase in reserves, so increase or reduction in the perception of risk of a countries, we have appreciation pressure. And the same with liquidity, the liquidity premium or risk or liquidity premium, the reserves are going up, the liquidity premium is going down as convertibility is becoming more likely or less of an issue. And of course, the opposite is the case in terms of bus. Now, while this direction is well defined in the short run, how it might well be heterogeneous as well as asymmetric over commodity boom and bust cycles, even in the short run. And the reason being is that most, and if not all of the primary commodity dependent economies don't have a freely floating exchange rate, at least not a de facto freely floating exchange rate. So heterogeneity is defined by the degree of intervention and policies maintained by the central bank in order to manage the macroeconomy, but also by the structural composition of the economy. So what is the percentage of imports? What's the percentage of consumption that is satisfied by imports, as well as what are the policies that are used in order to respond both to commodity boom and commodity bust cycles. And these might well be different. So commodity booms might be addressed differently or by different policies than commodity busts. So we have both heterogeneity across countries, or expect heterogeneity across country, as well as asymmetry between commodity boom and commodity bust. So negative price shocks and positive price shocks. And that's exactly what motivates our empirical analysis. Here we just give a few examples why, for instance, these asymmetries could exist. For instance, we might have a policy of sterilization of foreign exchange inflows over the boom period. However, if the buildup of reserves is an active policy choice, however, we might find that the reverse, so if you have a drainage of foreign exchange, it might, during a bust, it might be addressed differently. We might have a fixed, or we will have a fixed domestic production structure, which means that in times of a boom, it's relatively easy to switch to imports. However, it's relatively more difficult and slower to switch back to domestic produced consumer goods. We might have downward sticky fiscal expenditure, which means that the buildup of debt is asymmetric, whereby a government is trying to maintain a certain level of consumption and absorption, even if we are entering a commodity bust. And we also have the problem of, especially if you have inflation targeting regimes of a pro-cyclical policy rate during busts, as inflation is rising through the increased import bill, and therefore, we might see this kind of a cost push inflation effect materializing here. I will hand over to Rafael now for the method and data section.
Thank you, Sophie. Hi, everyone. Just to start talking about the empirical strategy that we came up. First, we just test for the Granger causality to understand the exogeneity between the pairs that we are comparing. Our strategy here is to do to understand the beaver rate process between the exchange rate and all the data that I'm going to talk about later. But for doing that, we are more interested in the understanding the asymmetric effect. So I think the only method that we, I mean, at least we identify as a possible important method to apply was the asymmetric Granger causality from the Hatimi. I'm sorry, I don't know how to pronounce his name well. And then in addition, we are going to test for the presence of symmetry and in the short and the long run using the nonlinear. It's very common. Nonlinear NARDL is the autoregressive distributed lag model. This model is particularly now well known, but it's a little bit different from the vector error correction. And we also we tested using the shocks from the structure var using the asymmetric var. It's important to talk about the NARDL because the model comprises a dynamic error correction. So with the asymmetric co-integration long run, which is interesting because captures not only the dynamic, the long run dynamics, but also the short run adjustments. And this model it overcomes some limitation of the previous methods. I mean, for instance, we can jointly modeling the asymmetries and then co-integration dynamics in a single step, and we can relax some hypotheses such as we don't need to be the all data to be the first order. We don't need to use the first difference, which I mean we know that we can omit some significant information if we differentiate the series. So we basically decompose the partial sums of the positive and negative chains. If you can skip one. Yeah. And we assume that we need to understand whether this bivariate relationship is asymmetric or non-asymmetric, and in the short and in the long run. For this, we pretty much defined the legs, the leg length using some criteria. For instance, we use the Schwarz criteria. We investigate the symmetries adopting the framework that I was talking about. We did the multivariate NARDL, takes this following form, which is basically we are combining all the data together and see the effects of each other. But actually, in this in the empirical results, we are only presenting the bivariate case, which we are going. Can you skip one slide just to talk about the data? Yeah, it's important to understand first actually the data, because the data that we choose based on our theoretical model was the exchange rate, the nominal exchange rate, the commodity index, and the sub-index. And we are using also the terms of trade as the export terms of trade index that we took from the IMF data. We also using the policy rate for the countries, the short-term debt, which basically we are using the reserve over debt. We are just doing the relation. And also we are using the reserve because we want to understand actually the relationship with the reserves. Can you just go back a little bit for the? Yeah. Oh yeah, the next one. So just moving up a little bit with to understand the asymmetries in the model, we use in the standard wall test. So pretty much we our hypothesis, new hypothesis, is whether we can reject the new hypothesis being asymmetric. And we also test for the co-integration using the BDM test and the Pessaran 2001 test. This was pretty much standard. This sort of steps to test for the NARDL. This model is also important because we understand that the economy it's a the shocks imposed in especially in the exchange rate for these countries is not asymmetric, and we are kind of hoping that we have some asymmetries in the model. So yeah, and we also tested for the structure VAR. So the structure VAR, I mean, in order to identify some causal relationship as well between the variables, we try to isolate the impact of the exogenous shocks in our involved variables. So we apply the structure VAR, and it's also interesting to compare the results of the NARDL and with the structure VAR as well. So it kind of gives us some robustness check to apply both methods. Yeah, this is our vectors, and we have like a matrix of restriction as well. Please, just one more. Yeah, our data start from 2003 up to 2021. This presentation we focus on the Brazil, as Sophie was saying, but we are also comparing Brazil, Chile, Colombia, and South Africa. Basically, why we are doing that? Because the four countries they're pretty much exporter as an emerging market and exporter commodity country. Basically, more than 50% of their exportation, their export is a commodity. So we select that, and we also select because the four countries also has the same implement the same strategy for the currency regime. They are flexible. They have like a exchange rate flexible regime, float regime. I mean, with the target inflation, both countries. And it's interesting to note that the 4 countries, they kind of implemented this target inflation and the float regime, the float exchange regime at the same time in 1999. I think Brazil has the worst transition compared to other countries, especially due to the Russia in 1998 and the Russian crisis. I mean, started with the Asian crisis in 1997, and then it hit Russia in 1998. In 1999, Brazil transitioned from the pegged to the fixed regime, fixed exchange regime, to the float exchange regime. But it's also important to note that all of these countries, they don't have a flexible exchange rate regime per se. They manage this the exchange rate by the central bank of their countries. So, for instance, especially for build up the reserve, as Sophie was saying, if you take the example of Colombia has pretty much build up their reserve, issuing some using some derivatives, special options and futures to build up their reserves. So if you can see on the plot that actually this is for Brazil, we have some we took from this framework from Franco that he just just like a new work paper from Franco that they categorize the regimes based on the econometric framework. So so if you see Brazil, we see the transition from the what they call free floating to BBC, which is basically a management exchange rate regime. So it's not totally free, which means that the central bank intervened in the market a lot. In Brazil case, the central bank they intervene, especially using derivatives, as we can see in the blue bar. Yeah, this is important also for us to understand that the Brazil has a very well consolidated derivative market for FX, for forex exchange. So which makes easier to sterilize, the shocks using this what we call swap cambial, which is basically it's a form of swap, interest exchange rate swap. So the central bank uses a lot to sterilize so the strategy of the central bank is using this sort of derivative, but keeping just to maintain the reserve steady. You don't use your reserve. You can you can hedge your position. You can do using derivatives to protect from the exchange rate. Moving up a little bit. Well, as I say, Brazil, in Brazil context, the primary commodities constitute over the 6 and 7% of the total exports. And I mean, Brazil is very well known for the main soybean exporter, also for the iron, crude petroleum, sugar, and meat, especially meat. So and a lot of other, but this is the main. But we are also a top importer. Brazil also is a really important importer of the refined petroleum. So Brazil is has like a depth in the, if you compare the export versus import of oil, especially diesel. And I mean, the main trading partners for Brazil are China and US, according to the USD. Here's the empirical part I'm going to start talking about, and Sophie will join me to explain a little bit of the results. Basically, for the symmetric Granger causality, as we can see, and if compared to other countries, I mean, Brazil, we have the unidirectional symmetric Granger causality from the exchange rate to our index, to the commodity index. It's important also to note that we are using we are using the commodity index, but we are also using the sub index, as Sophie mentioned earlier. And especially for Brazil, we are using the agriculture index as we see, and Brazil, the agriculture part of the export is the main part. So that's the reason that we are using the agriculture index, also metal. So this is confirmed the exogeneity from the nominal exchange rate to this commodity index. You can, Sophie, you can complement me.
Right, that was perfect. So we established that our commodity price shocks are indeed exogenous to the nominal exchange rate, which is important for the NARDL model because it is unidirectional. So we need to establish that before, and that's the NARDL model now. For where we have results for actually all 4 countries. You want to continue?
Yeah, that's just to understand that we see for the coefficient here is basically we reject the null hypothesis. So we have like for Brazil we have a asymmetric effect for the positive shocks. And interesting, if we, and also, so we could not reject the null hypothesis for the long run, which basically is kind of interesting to see the results. And also interesting when you compare these results with the structure var, if you can. So basically here we see that in the short run from the structure var that we have a positive effect, significant effect of the positive agricultural index shock for the exchange rate. So the response of the exchange rate is significant for the positive, but not for the for the negative, which is
smaller,
clear, yeah. Please, Sophie, go ahead. I mean,
yeah, just a few additions maybe to the NARDL model, which so it divides between the short run and long run. And as Rafael explained, it's a model selection procedure. So when we do estimate the NARDL, we test whether there are symmetries. If there are no asymmetries, then we revert back to a symmetrical model, and then the lag length is selected via information criteria. So we find actually asymmetries in the short run for almost all of the different currencies, but for Colombia. So Colombia is a bit of an outlier. It's also the only country that has a managed float. And the results we expect are quite different if you're doing different subsamples. Because as I said, or Rafael said as well, our time series here involves the COVID period. And when you remember the graph at the beginning, we can see that there seems to be some delinkage between the commodity price shock and the exchange rate during the COVID period. And our assumption is that this is related to the excessive borrowing at the time of crisis. So other factors basically taking prominence over the exchange rates, plus strong interventions by the respective central banks. So it might actually be worth to re-estimate this with subsamples that are cut the COVID period. Another interesting observation is that the only country where we have a significant long-run relationship and a significant co-integrating relationship that is also asymmetric is South Africa. And South Africa is the only country that in Frankel's et al. Paper, the recent one where Rafael said they empirically investigate what is the de facto exchange rate regime. So de jure, they all saying they all having a floating, not free floating, but floating and inflation targeting regime. De facto, most of them have a crawling band, plus in the case of Colombia, a managed float. And in the case of South Africa, it's the only case where actually a de facto float was identified since 2017 in that paper. So it seems to be the only country that actually freely floats, and it seems to be the one country out of a sample that it also has the strongest evidence for a relationship, a long-run co-integrating relationship between the commodity prices and the exchange rate. However, despite that free float, that relationship is strongly asymmetric, where we have a positive shock having a strong appreciation effect, while a negative shock is insignificant. So that's what this bit here at the bottom means. A similar result for Chile, but the co-integration is rejected. And again, I expect this to be also related to the intervention around the COVID period. For the others, we find asymmetries in the short run mainly. But yeah, so there's some robustness checks and subsampling needs to be conducted, probably also some recursive estimation to really see what's going on. And the structure of our, as Rafael said, what is very interesting, we did this estimation in order to really identify the transmission mechanisms. Right? So we identified these transmission mechanisms theoretically, which was our terms of trade. So this is these would be our terms of trade. Then we have the reserves, which stand our proxies for our liquidity premium. And then we do have reserves over debt, which is our risk premium. And this here is the interest rate differential. And we already said before we had this disclaimer about reserves not really being a good proxy here, because reserves actually are a policy variable in all of these four countries. They're not an endogenous variable. They're driven by policy choices and reserve accumulation, which is ultimately a policy choice for precautionary reasons. So this is also something that we see. So reserve, the impact of this positive agricultural commodity price shock on reserves, both the positive and the negative, is actually insignificant. So while it has the expected sign, so it's of course positive price shock would include a rise in the reserves, it's insignificant, and that tells you the degree of intervention that is taking place. For terms of trade, it's as expected as well. We have a positive price shock and we have a strong improvement in terms of trade, and this is significant. Again, the impact on terms of trade from a positive shock is stronger than from a negative shock. where you see the size being just above 0.4, and here for positive shock being up to 0.6. And that seems to drive or be a major part in driving the asymmetry that's defined or identified for the nominal exchange rate, where a positive price shock leads to a stronger appreciation than a negative price shock, which is marginally significant still. So a negative price shock would lead to a smaller depreciation, but smaller than the appreciation that we see in times of a positive price shock. Then another thing that was very interesting is actually the interest rate differential. And that's also strongly significant and interestingly also very sticky. And the hypothesis, or our hypothesis, is that part of this stickiness might be related to actually the sterilization efforts of the inflowing reserves. So it's basically the flip side of the insignificant reserves accumulation we're seeing here, that you have the persistent higher interest rate after such a shock materializing and reverting very slowly back to the previous level. For the debt, we have some oscillating relationship, and here's much stronger for a negative price shock, which kind of is expected because of consumption smoothing. When you have a negative price shock, where debt, part of this might be smoothed by debt. So this oscillating relationship is also because of the different movements in reserves and debt over that time, since that's reserves over debt. Yeah, Rafael, anything that you comes to mind?
No, I think that's it. Yeah.
Okay, then you're almost finished. I think that's our summary slide. So we established that the Brazilian real is a commodity currency, at least in the short run. Some subsampling analysis should be done. So it seems that during times of heavy intervention, there might be different regimes in place, and the heavier the intervention by the central bank, the less the exchange rate is sensitive to commodity price shock, it seems. The direction of causation very clearly leads from the commodity price shock to the exchange rate and not vice versa, which is one of the hypotheses that are evaluated in the literature as well. Commodity price booms and busts do impact the exchange rate differently, and we expect some of these observations to differ across countries as their intervention strategies also differ, and potentially also differ across time periods. Commodity price booms do have a stronger impact on the exchange rate, so stronger appreciation pressure than commodity price bust, and the main transmission channel still seems to be via the terms of trade and also the interest rate differential. However, there's a bit of caution here because we said from the start that the liquidity premium and the risk premium are not, the proxies that we currently have are interesting. However, there are policy variables rather than economic variables, and hence more exogenous to our model. So it tells us a lot about how the central bank intervenes. It might not tell us as much about the actual perceived risk and perceived liquidity premiums, since they are premiums that are attached to traders' perceptions. Yeah. So that the other measures that we had in mind will need to be used there. Yeah, policy intervention do attenuate the shock. The impact on reserves is insignificant, which shows us that Brazil quite happily intervenes. That's something that in other experiments we clearly have seen, and also that's well established in the literature as well. Yeah, so some expenditure smoothing impact. That's something that we said in the results already. Colombia seems to be the weakest case here, but also the case that the most strongly intervenes in the exchange rate. South Africa, the strongest commodity currency case, also the country that the least intervenes, at least more recently. So it's the only country with a de facto flexible exchange rate regime in recent years. And that's really it. I mean, these are our very preliminary results on Brazil, and it would we're very grateful for any thoughts on the experiments we still have in mind. Yeah, anything, and also questions for clarification, if you have any.
And thank you once again, Professor Victor, to have the opportunity to talk here.
Yeah,
Yes.
well, let me thank you, Rafael and Sophia, for a very interesting presentation. It's true the work is a technical, but that's as well because we need such a robust, technical analysis to inform any decisions that result into some policy changes. Many interesting aspects of your work. The coverage of the four support countries, I think, is very helpful. And what I liked is that basically you end up generating a different findings. And so you somehow subscribe if the devil is in the details or the angel is in the details, because taking the export commodity index as an aggregate, you actually don't see the beauty of it. But when you go down into the commodity sub-indices, then that's when you uncover very important peculiarities. You find these variations: Brazil, agriculture index; Chile, minerals and metals; Colombia, energy; and then South Africa, precious metals. This is interesting because what it is pointing to us is that we can't just say, one size fits all. The policy response of South Africa, cannot be, completely, the same as the policy response of Chile or even Brazil, because the details are in the sub-index. So the fact that this work goes into the sub-index is absolutely important. The theoretical aspect of the work is brilliant because you cover all the standard, international trade theories. You go also standard international finance theories. You invoke uncovered interest parity conditions and all that. This absolutely has a strong, theoretical base, interesting findings. The one comment I can give, just before I open up for the discussion, is that maybe we shouldn't really discount the role of reserves, as the paper seems to at the end. I can see the results from the impulse response functions, and whereby we say, okay, maybe reserves may not be so important. But suppose we reset the simulations for the impulse response functions and argue that, reserves being, policy tools, suppose that the decision for setting the reserves is for reserves for T+1, that's next year, okay? This is made on the basis of commodity price forecasts made at time T-1, that is last year. Okay, so the time dynamics itself may help us say to what extent. You see, if you evaluate the forecast made at T-1 and you evaluate it next year T+1, you are trying to disentangle the error and find out what what the forecast 100%, the mean absolute deviation for, or was it how much was it able to capture? No, suppose the forecast for reserves, capture 100% of the forecast in terms of the forecast for commodity prices last year was able to forecast a position, was used for forecasting the position for reserves of T+1, then reserves might be important. You see, I think reserves is possibly the determination of reserves would be possibly one important outcome for this discussion on commodity currencies. So maybe we researchers have another way to go to explore that in terms of the relevance of reserves. But at this juncture, let me open up the discussion to the flow. I can see that in the chat, I see a useful comment from Richard Alexander, who is a senior colleague here at SOAS, University of London. So I'll call upon him to put the question. Then I'll go into the chat. I can see a comment from Professor Robert Murinde, who is the chief economist of the Central Bank of Kenya. So let me start with you, Richard. Good to see you.
Hi, good to see you, Victor. Great that no teaching in term 3 means that I can get to these things. Yeah, I was intrigued by your note to the result to your results that you said you based your evidence on the country's chief export category, and I wondered whether it affects the results if a country has more than one significant export category, even if there's one that's the biggest one, if there's number 2, possibly even number 3, that are also also substantial, I wondered whether that made a difference. So I thought you, Colombia, as well as energy, you have agriculture in the form of coffee and bananas, South Africa, as well as precious metals, again, you have agriculture in the form of fruit production. I wondered if that affected the results.
Okay.
Victor, do you want us to respond, or do you want?
Please respond so we can set the discussion going, and maybe some of the participants, if you have a view on the question or the response, you can also join in before I go upon the second part. So please go ahead, Sophie or Rafael.
Let me start. Richard, that's a very good question. It's good to see you. We did the estimation for the second most important categories, so that makes it easy for me to answer. So for Brazil, we also used the metals category, and the results were very similar to the agriculture category. For South Africa, we also used metals in addition to precious metals, and there the results were very similar. For these countries, it's almost 50-50, as you know, so they're quite divided. So for Colombia, the share of agriculture is much smaller than for oil, interestingly. So that's where interesting differences occurred. So for Colombia, the results were different for agriculture, and actually the evidence for being a commodity currency was stronger for agriculture. However, you had in the short run a depreciation, and in the long run an appreciation. And part of this, I think, is related to Colombia also being a major food importer, not only a food exporter. So there you have like almost a switching of the results there. For Chile, the results where we also did agriculture as a second one. The results went into the same direction, but weaker, not as interesting as for Colombia, where you had this switching component happening. It showed similar results to the ones we had for metals. It's just that the size of the coefficient was smaller, but it was still significant. So yeah, in the end, we have a table actually in the paper draft that has the second categories as well. Another interesting observation is that when we use the overall commodity index, we couldn't reject the hypothesis of unidirectional causation. And I still haven't gotten quite my head around why this is. So it might be related to the prominence of oil, but that doesn't seem to cut it quite. So for the sub-indices, we have a very strong unidirectional. So we can, exogeneity is consistent and strong. For the overall commodity price index, it wasn't as strong. So either we had a very weak, could only reject it at the 5% level or 10% level, or we couldn't reject to have a bidirectional relationship. So that's also one of the reasons why we then went into the sub-indices, which is also something that in the literature has been done quite a lot. I mean, I guess now having done the Granger causality test, we know why. But yeah, I still have, so if you have a good idea of why there might be this bidirectional relationship for the overall commodity index, please let us know. That's something which I'm still thinking about.
Great,
Thank you. Thank you, Richard, and thank you, Sophie and Rafael, for the response. We now go to Robert Murinde. Professor Robert Murinde, the chief economist of the Central Bank of Kenya. Good to have you on board. Please go ahead.
Yeah, thank you very much, Professor Murinde. And thank you very much to both presenters for really insightful presentation. Very many sort of interesting insights, especially about the channels that you're considering. I just have a couple of comments. One is on choice of countries. So I noticed that there's only one African country considered, sub-Saharan African country, that's South Africa. You have 3 Latin American countries, yet there are quite a number of strong commodity exporters in sub-Saharan Africa that also have quite large economies, Nigeria, Angola, etc., etc. And I thought it would bring in a very interesting dimension and actually would ensure greater comparability if, for example, you had a couple of extra sub-Saharan African countries that are strong commodity exporters, then you'd be able to bring out sort of more interesting comparisons and contrasts between the countries. Because now you're dealing with Latin America, largely, that has its own dynamics, its own economic dynamics, its own drivers, its own sort of shocks, some peculiarities in exchange rate regimes, and then you have only one sub-Saharan African countries, that is South Africa. So that makes it very difficult to sort of make sort of broader comparisons. Yeah. And I think that would be one question. Maybe you're able to comment on that. But that struck me immediately, and I was thinking we'd have had a very sort of interesting analysis just by bringing out the comparisons a little bit more in more detail if you had several more sub-Saharan African countries that you were looking at. Yeah. A second point is on the co-integration methodology. I think you have also, I see you Spesseran 1998, etc., etc. I recommend also you look at, for your co-integration analysis, look at some more recent innovation time series, innovative methods in time series, especially methods that are more general. For example, Johansen 2014, fractionally co-integrated VAR. Yeah, that gives more refined, more very interesting results as well, and tends to be more general as well in terms of applicability. So maybe you can look at that as well as a potential methodological refinement. Yeah, Johansen's fractionally co-integrated VAR techniques as well. So that could be an addition, and that might be sort of useful refinement as well to your methodology. So those are my two sort of comments. Thank you.
Yeah, Rafael, do you want to answer? Thank you, Robert. Very good comments.
Yeah, of course, Sophie. We can please compliment me if I do not fully respond. Thank you for your question. It's really interesting, your comment. Actually, how we decided to choose South Africa because it's first, you know, that they export primary commodities, so it's very similar to Brazil and Chile and Colombia, but also it has the similar transition to inflation target and floating regime. And in addition to that, it's also because of the income. So basically, South Africa, Chile, Brazil, and Colombia, they share similar the income, the GDP per capita. It's around the upper middle income. So that's one of the reasons that we choose, and also because of the complementary of the different commodities. So that was one of the reasons, and I think we if we want to include other countries, I think it would be another research, because now it's to compare only the 4 countries, it's a lot of work. So I don't know if it fits in one singular research. So maybe it's a good step further to do it. I think I'll be very amazing to understand the peculiarities in the African countries. I think it's a great idea, but maybe we can expand later on. And for the talking about our strategy for the empirical part, you mentioned the fraction and var. I mean the NARDL, the nonlinear approach that we are using, it's kind of new approach as well. It's from 2014. We are just using the Perseran 2001 paper in order to understand the co-integration, but and we think that using the nonlinear distributed ligate, autoregressive distributed ligate, will be interesting to see, especially because we can understand the asymmetric effect, and not in the short run, but in the long run. We thought that it was more appropriate, especially based on our theoretical approach. So yeah, I mean, but we definitely can look to another approach as well.
Yeah, and Robert, let me tell you, so our omission of a lot of these sub-Saharan African countries is not out of lack of interest, definitely not. I would have felt much more comfortable since I know the macroeconomic situation of West African countries better than Latin America. But we started actually quite naively. So we started with thinking about what are the countries that are commodity dependent and are classified by the IMF as de facto floating and with an inflation targeting regime. And these were the countries which were on the list of consistently being classified as floating. Because the idea was, okay, then you have at least 4 economies that are relatively similar. Digging deeper, they're very different. And de jure is, of course, very different than de facto. So now thinking, okay, since that kind of broke down completely, the comparability or the similarity of these countries is not there, but actually the dissimilarity is more interesting than the potential similarity. Maybe adding some large sub-Saharan African countries might be quite an interesting addition, given that we have to let go of the idea that they're all a homogeneous group that we started out with in our slightly naive onset of our research a year and a half ago. I know the fractional co-integration model by Johansson. It could be an interesting, I'm not quite sure how to combine it with the NARDL, with the asymmetry. So I'm not sure, because maybe one could bootstrap the critical values, because the NARDL is specified quite differently because of that asymmetry. You have different critical values that you need to use. But let me think about it. I think it could be an interesting robustness check indeed, especially since we have these different regimes where countries seem to go out and into different regimes over time. So it might actually be an interesting addition. Thank you. Yeah.
Okay, thanks a lot for that. Just on the point, on Rafael's point on middle income, upper middle income status, Botswana, by the way, is also a country even that has a significantly higher per capita income than South Africa, and is also very commodity oriented as well. So if the rationale is also say upper middle income status, you have a number of African countries that still meet upper middle income status. And I can tell you that most African countries now are making a transition to inflation targeting. So that is kind of, and it's been going on almost for a decade now for many of the countries. So that transition is actually there. So I wouldn't say South Africa is the only one that basically is in an inflation targeting regime. Even our own country, Kenya, is actually in an inflation targeting regime as well. And I know quite a number of countries in the region as well. But anyway, I can understand probably you're also looking to sort of make the scope manageable. But it's something you could consider, just adding one or two more. It would add very interesting comparisons just in your analysis, policy recommendations, then they'd have broader applicability if you had, say, a couple of more sub-Saharan African countries. But I understand that it would mean quite a bit more analytical work. But thank you for the responses.
Thank you for your time, Robert, and your comments. Thank
you very much.
This is a absolutely interesting discussion, and thank you, Robert, for flagging up these issues. You see, part of the outcome of this Center for Global Finance seminars is just the manufacturing of new ideas, perception of new projects, and extending work in new directions. I think it's very much true that the result of this investigation and this paper could be scoping a possible extension to look at the peculiarities of African commodity-dependent economies, and say look at the scenario of commodity currencies in the context of African economies. In a Pan-African sense, you would get a large sample, data permitting, and data availability permitting, that would provide an interesting case study, as an in addition to this work. But this work, I think, was already cut out as it is, and I think could has got its own big merits to proceed. But we should not take very lightly the suggestion that there are interesting aspects of commodity currencies with respect to the African continent. Thanks very much. Now, there are two hands going up already. It's a thing that is Samuel Tiriongo and George Karachi. So I'll take the order they have come. So Samuel, who is a chief economist of Kenyan Bankers Association. Please go ahead, Samuel.
Thank you, Prof. Victor, for the opportunity, and thanks, Sophie and Rafael, for a very comprehensive and interesting presentation. I just have very few comments to ponder about, and of course, I think there is a lot of interest in the structure of VAR, and of course, the imposed restrictions, particularly on the A matrix. And I saw that its restrictions are uniform, particularly in a project that is seeking to understand relationships. So the contemporaneous relationships and exogeneities imposed would need to be revisited, and maybe now in the new frontiers of suggested methodologies could also be explored. The other thing that I wanted to comment about is, as you presented, you made a lot of inferences and detailed information provided on the Brazil trading patterns, and of course, a linkage with the US and China. And in my thoughts, as you mentioned about US and China, and of course, US, the contribution of US in reserve currencies across the globe becomes a point of reference here. So the question that I have is, does it matter when the importing country, particularly a trading partner such as the US, is also the supplier of reserve currency? Does that influence your analysis and outcomes at the end of the day? And the next question, and also the The other reference point is to the Chinese behavior, particularly on the policies on the exchange rate. And the question then that comes there is that, does it also matter when the counterpart in trading has been alleged to be manipulating currency, particularly the influence of that on trade and the conclusions therein that come from your paper? Thank you.
All right. So should I take it away?
Before George, just 1 minute, George. Let me see whether Sophie or Rafael want to respond or.
Yeah, I unfortunately had a malfunction with my headphones, but I think the first question, Samuel, was about the structural VAR and how we impose the restrictions, right?
Yeah.
Yeah. So this is not set in stone yet, and we had done some robustness checks on the, as you mentioned, particularly since we are interested in the transmission mechanisms, we need to be very careful to impose what of these variables is cause and what is effect. So what direction of causation we taking. So the one restriction we impose in all of our different estimations that we did is the one that our commodity price shocks are the most exogenous variables. So they are exogenous, while our exchange rate is allowed to be influenced contemporaneously by all other variables. So that comes from our model. We played around a little bit with everything that's in the middle, basically. So the sandwich part. The results or conclusions when it comes to the overall impact of the commodity price shocks on the nominal exchange rate was robust towards other types of specifications. The other channels, we have to dig deeper. So whether the size of the impact of the commodity price shocks via these channels is robust to these different specifications, that's something that we still need to go through. So the structure of our was a relatively late addition to the paper, unfortunately. But yeah, it's a very good point. So that's something that we definitely have on the top of our to-do list. So yeah, I was spotted. The other question I unfortunately didn't hear because I had to restart my wireless headphones. I'm really sorry. Maybe Rafael can answer the second part.
I think thanks, Samuel. It will be helpful, Sophie and Rafael, to share later on the copy of your paper with the Samuel, because that is where it will have in the paper some of the details of the restrictions imposed. And I could guess there are even further restrictions imposed on determining the lag length, across all the testing for causality, and then those technical issues. Then Samuel could have the chance to look at the detailed, granular technical details and maybe a response thereon. I guess that the question that you raised, Samuel, on the US, the dollar as a reserve currency is particularly important, and even the implications of the renminbi as now a reserve currency in some countries. I think that's very important. But I guess the one way of testing for this would be to do controls, to establish robustness controls and see, what happens if you take out some of those countries for which it's a reserve currency, and what happens if you don't. And those reserves would just signify, that the fact that we are all riding on the dollar as a reserve currency, and that makes the tenability of commodity currencies, a little bit, difficult. It could be in the testing.
Yeah, thank you, Samuel. Sorry, just to respond parts of the Samuel's question. Actually, we haven't tested for the difference of the reserves. Actually, especially in Brazil, there's a lot of discussion about the build up other reserves rather than US dollar, for instance, the renminbi from China, because China is Brazil's first partner. But I guess this discussion is a little bit earlier, especially for us to try to empirical test that. But I guess it's a really important, and I think maybe if there's some change in the reserve currency, probably we will have some different effects that we have now. I'm guessing that actually we need to test, but it's a good point, and I think in the future we can see this transition. Will be really interesting research to dig it. Yeah.
Yeah, thanks, Rafael, for that clarification to Samuel. And it's true that for Brazil, the renminbi is a strong partner currency within the BRICS. So important question. Samuel, do you want to have a follow-up, or that okay?
Yeah, I think it would be good to read the full paper when it's ready. It's a very interesting piece. Thank you.
Thank you very much. Thank you, Samuel. George, sorry for waiting. But let me check one thing, by the way. Sophie, are you still sharing? It appears you are sharing your screen. Yeah. Can you click on stop sharing and see what? Okay.
Yeah,
okay, that's
sorry,
good.
I forgot.
Yeah, that's fine. That's fine, because sometimes during the question and answer, somebody may want to look at one of the pages of the PowerPoints. In fact, I think I had flagged up a page to look at, but that's very fine. And so you did the right thing to sharing. Okay, George. George is an economic lead. That's a manager within the African Development Bank office. He's leading the economic research in the Southern African office of the African Development Bank. I was congratulating him this morning when I saw a new book that came out of Macmillan. I hope I guess this is one of the futures you are following, commodity currencies and all that. Please go ahead.
Yeah, I have a policy stance, and I think Professor Alexander kind of insinuated what I'm about to ask, which is this paper trying to inadvertently confirm the importance of diversification and the importance of value addition as a mechanism to absorb shocks in many of our commodity-dependent countries? Is that my interpretation is correct?
Mm-hmm.
George, yes, congratulations on your book. I mean, if this is on primary commodities, please do share. I would be very excited. Also, if it's on policy. And yes, we haven't talked about policy conclusions, but yes, inadvertently, this is one of the conclusions. So if you have a country which is primary commodity dependent, then you struggle to. So either you manage to intervene and manage your exchange rate, which has costs, as we all know, and that's something that comes out of our results as well. Or you are definitely leaving your exchange rate to co-vary with the commodity price shocks, which might not be a desirable outcome for your macroeconomic management, because, as we know, this makes your macroeconomy very volatile. And then also there's, of course, a policy debate that it ties into, which is also whether inflation targeting is then the right choice for countries that are commodity dependent, which is something that Victor mentioned right at the beginning, which are the bigger picture, right? The bigger questions of whether inflation targeting is a good strategy. And a lot of colleagues at SOAS and globally have very righteously laid out already, without maybe the mathematics of it, that inflation targeting is not a good strategy for commodity dependent economies, but have suggested maybe other either alternative anchors, which could be commodity export prices, or something, commodity currencies, where your currency is being anchored against your commodity wealth, and so on and so forth. I mean, the paper will not go into a lot of detail, but it relates to that literature very much when it comes to the policy outlook.
Yeah, thanks, Georgia, for this. In fact, you were spot on talking about the diversification, or indeed about the nature of commodities, because I was looking at one of the tables within the presentation where it shows a top, I think maybe for Brazil, top exports, among the top exports, there is crude petroleum. And then among the top imports, there's refined petroleum.
Yeah.
And so I said,
that's a very common theme. Yeah.
has been lost out in the export and import business. And I think these are some of the issues, and it's good to flag this up. So thank you for that observation. Do you want to briefly tell us about your book, George? Take this opportunity to the title. I was just looking at you. I was just looking for your title, the title in the congratulatory message. Yes. The political economy of global manufacturing, business and finance. The International Political Economy series of Macmillan. So this is that's the one. Yeah. That's what I was looking for.
Well, so very quickly, I think we have 14 chapters in the book, with quite a number of very diverse authors, from Diane Elson. I think you are in Manchester, so you might know Diane Elson. So Diane Elson, there's Jasmine Gideon from Birkbeck College, and Peter Lawrence from previously at Kiel. There are quite a number of guys, but majority of them were either friends of Frederick Nixon, who was also at the school there in Oxford Road in Manchester. So the book came out as a result of, should we say, a tribute to Frederick Nixon's contribution to the debates on developing countries, and particularly issues on development policy. And so the issues covered in ranges from industrial policy, the role of manufacturing, issues around skills and technology diffusion, knowledge transfers, issues around, in fact, we almost concluded that development economics has come back to Manchester because you also behave like a developing country. Issues around climate change, issues around inequality, all the things that were associated with developing countries are now hanging around in Manchester. So we thought it was a very, very apt way of paying tribute to Fred Nixon in that regard. So I think Jasmine and others will do a book launch, if not in SOAS, then in Birkbeck College. And I might be coming to London. There's a possibility of me visiting at LSE. So I think maybe I should organize a seminar with Victor when I'm in town. I will be there in July.
Thank you very much. We'll do a book launch, your book at SOAS, and maybe also in Manchester, because this is the home of Asa Lewis, the Nobel Prize winner for origin at Manchester. So, colleagues, sorry for the diversion, but I could not miss the opportunity of congratulating George and Prolific, and I know a couple of books that he's now working on. Let's go back to the key questions. So I see my colleague here, Hong Bo, is a professor of financial economics at SOAS. Hong.
Yeah, sorry. Thank you, Sophia and Rafael, for the presentation. I think the topic is definitely up to date and very popular. I'm thinking about something, the sample that you have not used in your empirical analysis, but they are relevant. So let me draw a pie to represent the whole commodity market. Maybe 2/3 of them, the commodity trades are based on the US dollars, but there are some commodity market transactions are not based on the US dollars. Yeah, think about the Ukraine war. the Russians commodity transactions are now out of the US dollar system. And think about the transactions between, for example, China and the Middle East countries. They trade based on non-US dollars. Now, I mean, more and more Chinese currency. Also, Central Asian countries, they are resource-rich countries, and they are trading something, but not really based on the US dollars. And some of the export of the commodities actually are used to pay back debts, the investments, for example. So my question is, for this part of commodity transactions, obviously, the volatility of the global commodity market will be much more affected by them. So you use the commodity index for your sample countries that is already, actually that contains the whole volatility of the global market. So I do not know how to solve this problem. Maybe you can control a variable or something, but you're using the ADL model. So I do not know how to solve this, but did you consider this? So that's basically my concern.
I think I'm not. I mean, you might have to clarify. But let's discuss. So we had concerns about when it comes to the exchange rate, only having the nominal exchange rate was the US dollar. So we tried also the effective exchange rate, which is like the basket rate, the basket of different exchange rate, and the results were basically identical. But when it comes to the commodity price index that we're using, it's the IMF index. So they convert everything into US dollar. So you mean from the volatility, are you concerned about the currency fluctuations of other trading partners then also impacting the volatility of the world price, because you convert the world price back to the US dollar to make it comparable?
I think that's the key issue, the fundamental issue. So so that's why you may need to control for the part of transactions that are not directly based on the US dollars, or you have something else. But that's my question. So the commodity indices that you used for your sample countries, for example, already contain the volatility of the commodity market that are not directly treated based on US dollars. So is that an issue? So to me, it's probably.
I will have to think about whether this is an issue. So so you're right. The overall commodity index, price index that we're using has the volatility, which has the volatility of the commodity prices. And then also for the markets that are not US based, volatility of the exchange rates for converting them into US dollar to put them all into one index. So that's definitely the case.
So it is in the commodity indices because you take the global, the average something, and you measure them, but they may not be. They may not be in the exchange rate because they do not really do the transaction based on US dollar.
But wouldn't that not be solved by using the effective exchange rate? Because that would then correspond to, it's also a composite. So you would have two composites, and one reflecting the nominal exchange rate variation with respect to the US dollars and the other trading partners, which is then the volatility that also is contained in the overall commodity price index. Would that not solve the problem?
Maybe partially, or maybe, but I'm not an expert on this. But I think that's my concern as a layperson, and based on my understanding of how the commodity market is functioning.
I will note this down. It's a good. I will have to think about it. It's a good point. Yeah. Thank you.
Thank you.
Thank you very much, Hong and Sophie and Rafael for the responses. Yeah, I just looking again at my notes taken during the presentation, and noted that there are other strong reasons why the sample focus was in Brazil, Chile, Colombia, and South Africa. Was because of somehow implications of the derivative market, I guess, in looking at the risk premium, because some of the countries that we may have consider may not have a derivative market in especially some of the commodities. So that may limit even the sample of countries. Now, actually, there is an ongoing paper of mine in which we are looking at various ways of combining the indices. It's a rich area, and I guess one can go either way. It's the gift of the researcher to select the tools which they want to use for untying unpicking the dimensions of the commodities and their volatilities, I guess you see, if you have the relative prices, that's also by definition a real effective a real exchange rate. Is the ratio of the kind of prices different domestic and foreign. So yes, there is quite a lot of latitude in terms of how one can go around these mechanics. Let me look at the chart to see if I have any more comments. No, I think people had to leave. The comment by Richard has left. It says the second paper looking principles of Southern Africa could be interesting, as those are similar to those studies that look at principles of Latin America, and what does this imply for the evolving markets, especially the commodity markets in the continent. So we shall revisit this bilaterally in terms of how this work. This work has already motivated, potential, future work, in addition to completing the work for publication. It appears that we don't have any more questions, but also we are just about 10 minutes to the end of the session. So let me take this opportunity to thank the Sophie and Rafael, and maybe I should give them 1 minute to say a final word before I close the seminar. We have a quick comment, a quick one in view of time, from Vasilios, who is also an active member here of Center for Global Finance. So Vasilios presented a very interesting paper here recently. So please go ahead, Vasilios.
Sorry, Victor, I was trying to congratulate the authors for the excellent presentation, but I mixed the buttons in Teams. I really like the presentation, and the comment on the fractional cointegration is a technique that I have also used. So it was very interesting. Yeah. Thank you.
Excellent. Yeah. This is a very modern economic techniques on display here. Thank you very much. Okay, so I'll go back and ask Sophie and Rafael to give us their final word, and then I can close the session.
Just thank you so much for excellent comments, excellent questions, lots of food for thought. Thank you, Victor, for the invitation, for Athena for facilitating the seminar so expertly, and thank you for having us.
Thank you a lot, Victor, for the opportunity to talk about our paper here, and for excellent comments that we definitely leave here with a lot of research questions for the future. So thanks a lot. And
thank you too, Sophie and Rafael, for this excellent work, and especially sustaining our network on this role of our commodity prices. There is quite a thrust of research in this area, but also the challenges facing the global community today. One needs to look again at these issues of commodity prices, commodity cycles, implications for commodity currencies. So this is quite right, quite right on the money, as they say. And I hope we have stimulated the interest of many participants here to work along this area, and also to give you encouragement, Sophie and Rafael, to continue mining away. And later on, we'll be happy to see your paper and share it amongst the Center for Global Finance fraternity. Let me also take this opportunity to thank you participants, because without you, we wouldn't be having a seminar. Thank you very much. And let's get it done. Until next week.